Picture this. An 11-year-old boy walks into a broker's office in 1942, clutching three $38 bills he's saved from delivering newspapers and selling Coca-Cola door to door. He's about to make his first stock purchase, and he's about to learn the most expensive lesson of his life. One that will cost him not dollars, but something far more valuable. One that will haunt him for decades. That boy was Warren Buffett, and what happened next would shape every billion-dollar decision he'd ever make. But let's rewind further. Because before Warren Buffett became the Oracle of Omaha, before he became one of the richest men alive, he was something else entirely. A hustler. Not in the modern sense. No crypto schemes or dropshipping courses. Warren was hustling in the original sense of the word. Obsessed with one singular question that consumed his every waking moment. How does money actually work? At age 6, Warren was buying 6 packs of Coca-Cola from his grandfather's grocery store for 25 cents and selling individual bottles for a nickel each. Do the math. That's a 20% profit margin before he could ride a bike without training wheels. Here's where it gets interesting. Most kids would pocket that nickel profit and buy candy. Warren, he was studying something else entirely. He noticed that some flavors sold faster than others. That location mattered. Sell near the park on hot days, and you'd move 3 times the inventory. He was learning what business schools would later call supply chain optimization and consumer behavior analysis. Except he was doing it with glass bottles and a radio flyer wagon. But the real lightning bolt struck when Warren was 7 years old. He borrowed a book from the Omaha Public Library called 1,000 Ways to Make $1,000. Now think about what's happening in a child's mind at this moment. Most 7-year-olds are reading about talking animals and magic trees. Warren is reading about capital accumulation strategies. One passage stops him cold. It's about compound interest. Here's the analogy that changed his life. If you fold a piece of paper 42 times, it would reach the moon. Sounds impossible, right? But it's mathematically true. That's compound interest. It doesn't move in a straight line. It curves. It bends. And at a certain point it explodes. Warren did the calculation that would become his North Star. If he could save $1,000 and earn 10% annual returns, by age 60 he'd have over $176,000. But if he started at age 20 instead of 10, he'd only have $67,000. Same money, same returns. Starting just 10 years later would cost him over $100,000. This hit Warren like a freight train. Time wasn't just money. Time created money. Every year he waited was a year he'd never get back, because it wasn't about working harder in the future. It was about the mathematics of time itself. So Warren became obsessed. Fanatical. He started viewing everything through this lens. How could he compress more earning years into his life? How could he start the compound interest clock now? Which brings us back to that broker's office in 1942. Warren didn't just walk in with $114 of his own money. He'd convinced his sister Doris to pool her savings too. They bought 3 shares of Cities Service Preferred at $38 per share. A utility company. Safe. Boring. The kind of stock a responsible 11-year-old would buy. And then it immediately dropped to $27. Here's what happens in your body when you lose money. Your amygdala, the ancient reptilian part of your brain that kept your ancestors alive when saber-toothed tigers attacked, that part lights up like a Christmas tree. Loss activates the same neural pathways as physical pain. Now imagine you're 11 years old. Your sister checks in with you every single day. Warren, what's happening with our stock? And every single day you have to tell her they're down. You've lost your sister's money. Money she saved from birthday gifts and chores. Warren couldn't sleep. He felt physically sick. This wasn't a spreadsheet. This was betrayal. He'd promised her this was a smart investment. So when Cities Service finally climbed back to $40, just $2 above their purchase price, Warren sold immediately. Took the tiny profit. Got out. The relief was intoxicating. He'd made it back. They were safe. Then Warren watched, helpless, nauseated, as Cities Service Preferred climbed to $202 per share. Let's do that math together. If he'd held those 3 shares, his $114 investment would have become $606. That's not just money. That's a 432% return. That's the difference between being clever and being right. But here's the deeper cut, the wound that never fully healed. Warren didn't just sell because the price recovered. He sold because he couldn't handle his sister's disappointment. He sold because he let emotion override analysis. He sold because he was thinking in weeks when he should have been thinking in years. This is the moment right here, when Warren Buffett makes a promise to himself, a vow that would guide the next 8 decades. Never let fear make your decisions. Never confuse temporary price movements with permanent value changes. Now most kids would have called it quits with stocks after that trauma, stuck their money in a piggy bank and forgotten about it. Warren went the opposite direction. He decided he needed to understand business, real business from the inside out. Not just buying pieces of paper and hoping they went up. He needed to see the mechanics, the cause and effect, the levers that actually created value. So at age 15, Warren and a friend bought a used pinball machine for $25. Stay with me here because this is where it gets fascinating. They installed it in a barber shop. The deal was simple. They'd split the profits with the barber. That first day, they emptied the machine and found $4 in quarters. $4 from one machine in one location in one day. Warren's mind was racing. If one machine generated $4 a day, that's $28 a week. That's roughly $1,400 a year. From a $25 investment, that's a 5,600% annual return. Within months, they had 8 machines across different barbershops. Warren would ride his bicycle across Omaha, collecting quarters, performing maintenance, negotiating with barbers. He was learning something that business school professors would never teach him, the visceral reality of asset deployment. Here's the analogy. Most people think business is like playing poker. You win some hands, you lose some hands, you need luck. Warren was learning that business is actually like owning the casino. You don't need to win every hand. You just need to make sure the math is in your favor, and volume does the rest. Simultaneously, Warren was running multiple newspaper routes. But he wasn't just delivering papers, he was optimizing a distribution system. He'd memorized every house on his routes. He knew which customers tipped, which paid late, which wanted the paper on the porch versus the doorstep. He'd calculated the exact optimal path to minimize bicycle mileage, while maximizing delivery speed. But here's the part that reveals how his mind worked. Warren noticed that apartment buildings were more efficient than houses. One building might have 20 customers, all in the same location. Same delivery time as one house, but 20 times the revenue. So he started specifically soliciting apartment buildings. He was doing customer acquisition cost analysis as a teenager with no formal business training. 440, the income revelation. By age 16, Warren Buffett had saved $6,000. In 1946 dollars, that's equivalent to roughly $95,000 today. Let that sink in. A 16-year-old, through paper routes and pinball machines, had accumulated what would take most adults years to save. But here's what Warren understood that changed everything. That $6,000 wasn't just money. It was time. If he invested it at 10% returns, by age 60 it would become $2.6 million without adding another penny. The compound interest clock was ticking. Every dollar he earned now was exponentially more valuable than a dollar he'd earn at 30 or 40. Time was his secret weapon and he was using it. Warren applied to Harvard Business School. He was rejected. In his own words later, he said, "I probably looked about 16 and acted like 12. I was terrified of the interview." But here's where fate intervened. Warren discovered that Benjamin Graham, the man who literally wrote the book on securities analysis, the godfather of value investing, was teaching at Columbia Business School. Most people don't know this, but Warren actually wrote Graham a letter before applying to Columbia. He didn't just express interest. He demonstrated that he'd read Graham's book The Intelligent Investor multiple times, that he understood the principles, that he was already applying them. Graham's philosophy was revolutionary for its time, and it's worth understanding because it became the bedrock of everything Buffett would build. Here's the analogy Graham used. Imagine you have a business partner named Mr. Market. Every single day, Mr. Market offers to buy your share of the business or sell you his share. And every day he quotes you a different price. Some days he's optimistic and offers you a high price. Some days he's depressed and offers a low price. The key insight: you don't have to trade with Mr. Market just because he makes an offer. You can wait. You can be patient. You can only trade when the price is so absurdly good that you'd be foolish not to. Most investors in the 1950s were doing what Warren had done at age 11, watching prices obsessively, reacting emotionally, buying high on excitement and selling low on fear. Graham taught something else that embedded itself into Warren's DNA: the margin of safety. Think of it like this. If you're building a bridge that needs to hold 10,000 pounds, you don't design it to hold exactly 10,000 pounds. You design it to hold 30,000 pounds. That buffer, that cushion, is your margin of safety. In investing, this means you don't buy a stock worth $100 for $95 and call it a good deal. You wait until you can buy that $100 stock for $50, maybe even $40, because you might be wrong about the valuation. The business might deteriorate. The economy might tank. The margin of safety doesn't eliminate risk. It makes risk survivable. One Saturday during his time at Columbia, Warren took a train to Washington, D.C. He went to the headquarters of GEICO, a company Graham had mentioned briefly in class, and knocked on the door. It was locked. The building was closed. It was Saturday. Most people would have left. Warren kept knocking. Eventually, a janitor answered. Warren explained he was a student of Benjamin Graham's and wanted to learn about the company. The janitor, probably confused but impressed by this kid's persistence, let him in and mentioned that one of the executives was upstairs working. That executive was Lorimer Davidson, who would later become GEICO's CEO. Davidson spent 4 hours on a Saturday, explaining GEICO's business model to a 20-year-old college student. Here's what Warren learned that transformed his understanding. GEICO sold car insurance directly to customers, bypassing agents and brokers. That meant lower costs, which meant lower prices, which meant more customers, which meant more scale, which meant even lower costs. It was a flywheel, a competitive moat, a compounding machine built into the business structure itself. Warren went back to New York and invested 65% of his net worth, $10,800, into GEICO stock. Within a year, that investment returned 50%. Warren had turned $10,800 into over $16,000. But more importantly, he discovered something that would become his signature: the power of finding excellent businesses with sustainable competitive advantages and holding them, not trading them like baseball cards. This wasn't luck. This wasn't a hot tip from a broker. This was doing the work no one else wanted to do, knocking on doors on Saturday, asking questions for 4 hours, understanding the fundamental economics, and having the conviction to bet big when the analysis was clear. After Columbia, Warren went to work for Benjamin Graham's investment firm. He wanted to stay in New York, work for his mentor, and keep learning. But after a few years, Graham decided to retire and close the firm. Warren, now 25 years old, moved back to Omaha. He had a decision to make: take a conventional job on Wall Street, or do something different. He chose different. In 1956, Warren gathered 7 family members and friends in his living room. His pitch was simple but audacious. Give me your money. I'll invest it. I'll take 25% of any profits above 6% annual returns. I'll take 0 salary. And I won't tell you what I'm investing in. Think about that for a moment. He's asking for money with no transparency, no track record of his own, and no immediate income for himself. But here's what he was really saying: I'm so confident in this approach that I'm willing to eat nothing unless I beat the market significantly. And I'm so focused on results that I don't want the distraction of explaining every decision to people who might second-guess me. 7 people gave him $105,000. Warren added his own $100. Total starting capital: $105,100. One of Warren's early investments perfectly illustrates his thinking. Sanborn Map Company created detailed maps for insurance companies showing the location of fire hydrants, building materials, all the information needed to assess fire risk. They'd been doing this for decades. They were profitable but boring, and the stock traded cheaply. Here's the kicker Warren noticed. Sanborn owned an investment portfolio, stocks and other companies, that was worth more than Sanborn's entire market capitalization. Let me rephrase that. You could buy the entire Sanborn map company, get a profitable mapping business, and the investment portfolio they owned would be given to you for free. Actually, better than free, the market was essentially paying you to take the mapping business off their hands. But the management wasn't interested in unlocking this value. They liked things as they were, collecting their salaries, running a sleepy company, no pressure. So Warren did something that would become his pattern. He bought more and more shares until he had enough to demand change. He got a board seat. He pushed management to distribute the investment portfolio to shareholders. It worked. The stock price doubled. This wasn't Graham's pure value investing anymore. Warren was adding a new layer. He was willing to be an activist, to push for change, to unlock value that passive investors would never capture. He was learning that patience was powerful, but strategic impatience could be even more powerful. Another early investment. Dempster Mill Manufacturing, which made farm equipment and windmills. Warren bought the company for less than its liquidation value, meaning he was buying it for less than he could get if he just shut it down and sold off all the assets. Classic Benjamin Graham strategy. But Dempster was losing money. The management was incompetent. The inventory system was a disaster. Warren had bought a bargain, but bargains stay cheap for a reason. Warren brought in Harry Bottle, a turnaround specialist. Bottle was ruthless. He fired excess workers, slashed inventory, optimized operations. It wasn't pleasant. This was people's livelihoods, but it was necessary. The company went from losing money to making money. Warren sold Dempster 3 years later for nearly 3 times what he paid. But something was gnawing at him. The emotional toll of these turnarounds, the cigar butt investments as he called them. Buying something cheap, taking one puff and throwing it away, it wasn't satisfying. It worked mathematically, but it felt hollow. He was beginning to realize something profound. There's a difference between buying something cheap and buying something great. In 1959, Warren met Charlie Munger at a dinner in Omaha. Charlie was a lawyer who'd grown up in Omaha, worked in California, and had also become obsessed with investing. But Charlie's approach was different from Graham's. Charlie believed that paying a fair price for a wonderful business was better than paying a bargain price for a mediocre business. Here's the analogy that Charlie used to change Warren's mind. Imagine you can buy $1 for 80 cents. That's great. You make 20 cents. But now imagine you can buy a machine that produces dollars. Maybe it costs $1 now, but every year it produces $1.20, then $1.44, then $1.73, compounding forever. Which would you rather own? The one-time 20-cent profit, or the machine that compounds forever? Warren had been trained by Graham to focus on the discount, buy things trading below intrinsic value, wait for the price to correct, sell, repeat. It worked, but it required constant hunting for new cigar butts. Charlie was proposing something revolutionary. Find businesses so excellent that time works for you instead of against you. Find companies that get more valuable every year, not less valuable. The pivotal moment came in 1972 when Warren and Charlie considered buying See's Candies. See's wanted $25 million for the business. By Graham's standards, this was expensive. See's had only $8 million in tangible assets. You were paying $17 million for what? Brand? Goodwill? Intangibles? The old Warren would have walked away. But Charlie pushed him to think differently. Here's what they realized. See's could raise prices every year without losing customers. People didn't buy See's Candies because it was cheap. They bought it because it was See's. It was part of California culture, a tradition, a gift people gave because of what it represented, not because of cost-benefit analysis. That meant See's had pricing power. Maybe the most underrated concept in all of business. Think about it this way. Imagine 2 businesses. Both make $1 million in profit this year. Business A has to cut prices every year to compete, so next year it makes $900,000, then $810,000, then $729,000. It's a melting ice cube. Business B can raise prices 2% every year above inflation. So next year it makes $1.02 million, then $1.04 million, then $1.06 million. It's a compounding machine. Over 30 years, Business A has withered to nothing. Business B has multiplied 7 times. Warren and Charlie bought See's for $25 million. Since then, See's has produced over $2 billion in pre-tax earnings for Berkshire Hathaway. That's an 81 return. But it's more than that, it gave Warren the capital to make bigger investments which generated more capital which enabled even bigger investments. C's wasn't just a good investment. It was a lesson that transformed everything. Quality compounds. Mediocrity deteriorates. And the price you pay matters less than the business you're buying, as long as you're not overpaying egregiously. By 1969, the stock market was in a frenzy. People were buying anything with growth prospects. Valuation didn't matter. Speculation was rampant. It reminded Warren of every bubble he'd ever studied. He made a shocking decision. He dissolved Buffett Partnership Limited. He returned all the money to his partners, money that had grown at 29.5% annually for 13 years, turning that initial $105,100 into over $100 million. But Warren didn't stop investing his own money. He'd been accumulating shares in a struggling textile company called Berkshire Hathaway. It was another cigar but investment that should have been quick. But Warren kept buying more shares until he controlled the company. Here's where the story gets interesting. The textile business was dying. Foreign competition, changing markets, thin margins. It was a disaster. Warren tried for years to make it work, pouring money into new equipment, better management, modernization. Nothing worked. The textile business was a slow-motion failure. But Warren had realized something else. Berkshire Hathaway could be a holding company. He could use it to buy other businesses. And the perfect business to buy was insurance companies. Here's why insurance is genius. People pay you premiums before you have to pay out claims. That gap between collecting premiums and paying claims means you're holding other people's money. That money is called float. Think of it like this. Imagine someone gives you $100 and says, I might ask for it back in 5 years, maybe 10 years, maybe never. But until then you can invest it and keep all the profits. That's insurance float. And if you're good at underwriting, meaning you collect more in premiums than you pay in claims, people are essentially paying you to use their money. Warren started buying insurance companies. National Indemnity, GEICO, again this time acquiring the whole company. General Re. Each acquisition brought more float. More float meant more capital to invest. More investments meant more profits. More profits meant more float. It was a flywheel inside a flywheel. In 1988, Warren made what would become his most famous investment, Coca-Cola. But this wasn't just buying a stock. This was Warren applying 3 decades of evolved thinking into one perfect decision. Coca-Cola had stumbled. They'd launched New Coke, one of the biggest marketing disasters in history. The stock was down. Investors were nervous. Wall Street was skeptical about management. But Warren saw something else. He saw a company that sold a product with these characteristics. 1. People consumed it repeatedly. You don't buy Coke once and you're done. You buy it today, tomorrow, next week, forever. 2. It had brand loyalty that bordered on religious fervor. People didn't just prefer Coke, they identified with it. 3. The unit economics were extraordinary. Coca-Cola syrup was cheap to produce but sold at a massive markup. The company essentially sold flavored sugar water for premium prices. 4. The global expansion opportunity was massive. Coca-Cola was already everywhere. But consumption per capita in developing countries was a fraction of the U.S. As those economies grew, Coke consumption would grow. Warren invested $1 billion. At the time, the largest single stock investment Berkshire had ever made. Wall Street thought he was crazy. Why buy a company that just had a massive failure? Why buy a company trading at what seemed like a high multiple? Because Warren wasn't buying the last quarter's earnings. He wasn't buying last year's stock price movement. He was buying the next 30 years of cash flow from a business that would get stronger every year. That $1 billion stake is now worth over $25 billion. But again, it's more than the return. It's the lesson. When you find a truly extraordinary business at a reasonable price, you don't buy a little bit. You bet big. Another example of this evolved thinking. American Express in 1963. American Express had a subsidiary that provided authentication services for vegetable oil shipments. A con man named Anthony DeAngelis had been forging documents, claiming he had massive amounts of salad oil in storage when the tanks were mostly filled with seawater. When the fraud was discovered, American Express faced hundreds of millions in liabilities. The stock crashed 50%. Everyone was selling. Warren did something brilliant. He didn't just read financial statements. He went to restaurants and watched whether people were still using American Express cards. They were. In droves. The salad oil scandal had nothing to do with American Express's core business, the credit card and traveler's check operations that people loved and depended on. The market was panicking about a subsidiary problem and punishing the entire company. Warren saw a temporary crisis creating a massive opportunity. He invested 40% of Buffett Partnership's assets into American Express. Within 2 years, the stock had tripled. Or the Washington Post in 1973. The stock market was crashing. The company's stock price had been hammered. You could buy the entire Washington Post company for $80 million. Warren estimated that the assets, the newspaper itself, the TV stations the company owned, the other properties, would sell for at least $400 million if someone wanted to buy the whole business. So the market was valuing a $400 million business at $80 million. An 80% discount to intrinsic value. But here's the part that separates Warren from every other investor who could have made the same calculation. He bought and held through the continued decline. The stock kept dropping. It fell another 20% after he bought it. Over the decades, Warren built Berkshire Hathaway into something unique. A holding company that owns dozens of businesses outright and substantial stakes in many more. But the structure is unusual. There's no corporate headquarters filled with lawyers and consultants. There's a tiny office in Omaha with about 25 people managing a company worth over $800 billion. Warren operates on a few key principles that he shared in what he calls the owner's manual. 1. He doesn't care about quarterly earnings or stock price fluctuations. He cares about growing per share intrinsic value over the long term. 2. He gives the managers of Berkshire's subsidiaries almost total autonomy. He doesn't micromanage. He hires excellent people, trusts them, and lets them run their businesses. 3. He allocates capital. That's his primary job. When a subsidiary generates cash, Warren decides where to invest it for the highest return. This structure creates something powerful. Managers can think long-term because they're not pressured to hit quarterly numbers. They can invest in their businesses without worrying about short-term stock reactions. Every year, Warren writes a letter to Berkshire shareholders. These aren't the typical corporate communications filled with jargon and lawyer-approved nonsense. They're clear, honest, often funny assessments of what worked, what didn't, and why. He writes them as if he's talking to his sisters, intelligent people who don't work in finance but want to understand what's happening with their investment. This transparency creates trust. Shareholders aren't customers to be manipulated with public relations. They're partners to be informed honestly. Now here's where we need to address something crucial. Warren Buffett's success isn't replicable in the way most people think. Yes, you can apply his principles, buy excellent businesses, hold them for decades, think like an owner, not a trader. Those principles work. But Warren had something else. He started at age 11. He let compound interest work for 7 decades. He had the personality to be calm during crashes. He had the intellectual horsepower to understand complex businesses. And he had a partner in Charlie Munger who challenged his thinking and made him better. But here's what is replicable. The mindset. Warren doesn't think in quarters or years. He thinks in decades. When he buys a business or a stock, he's asking, will this be more valuable in 20 years? Most investors are asking, will this be higher next month? That difference in time frame creates a different set of questions, different analysis, different decisions. It filters out 99% of the noise and lets you focus on what actually matters. Is this a good business? Is it well managed? Is the price reasonable? Warren also lives by the principle of circle of competence. He only invests in businesses he understands. He passed on Google early on because he didn't understand the business model well enough. He's passed on countless tech investments because they're outside his expertise. This sounds limiting, but it's actually liberating. You don't need to know everything. You just need to know your edge, stay within it, and be honest about its boundaries. Think about that. One of the richest investors in history openly admits there are huge sectors he doesn't understand and won't touch. That's not weakness, that's wisdom. Warren also learned from Philip Fisher, who taught him to look for companies with Scuttlebutt, insider knowledge about a company's quality. Fisher would talk to competitors, suppliers, customers, former employees. He'd build a 360-degree understanding of a business. Warren adapted this. Before investing in a bank, he'd talk to competitors, look at their loan books, understand their culture, assess their risk management. He wasn't just reading annual reports. He was doing detective work. The concept Warren became famous for is economic moats, sustainable competitive advantages that protect a business from competition, like a moat protects a castle. Moats come in different forms. Brand power, Coca-Cola, C's Candies. Network effects, American Express. Cost advantages, GEICO's direct sales model. Regulatory barriers, insurance licenses, utility monopolies. The key is durability. A business might be profitable today, but if competition can easily enter and compete away those profits, the moat is shallow. You want deep moats that widen over time. Warren also obsesses over management quality. He looks for 3 characteristics. 1. Intelligence, not raw IQ, but business judgment and the ability to allocate capital wisely. 2. Energy, the drive to keep improving the business, not just maintain it. 3. Integrity, the hardest to fake and the most important. Warren won't partner with people he doesn't trust, regardless of their talent. He has a saying, in looking for people to hire, look for 3 qualities: integrity, intelligence, and energy. And if they don't have the first, the other 2 will kill you. Warren is now 94 years old. He's still going to the office every day, still reading annual reports, still making investment decisions. He's donated the vast majority of his wealth to charity. Over $50 billion to the Gates Foundation and other causes. But here's what's fascinating. He's not nostalgic about the good old days of investing. He doesn't claim that today's markets are impossible to navigate. He's adapted. In 2016, Berkshire started buying Apple stock. This shocked people. Warren Buffett, the guy who avoided technology stocks for decades, was buying a tech company? But Warren's explanation was perfect. He didn't see Apple as a tech company. He saw it as a consumer brand with extraordinary loyalty, pricing power, and an ecosystem that locked customers in. It was C's Candies meets American Express, wrapped in a smartphone. That stake has become one of Berkshire's most valuable holdings, worth over $100 billion at its peak. Warren was 86 years old when he made that investment. Still learning, still adapting, still applying the same principles to new situations. Warren has been transparent about succession. He knows he won't be around forever. He's groomed managers like Greg Abel and Ajit Jain to potentially take over Berkshire. He structured the company to survive without him. But here's the deeper lesson. Berkshire isn't valuable because of Warren Buffett's genius. It's valuable because of the collection of excellent businesses he's assembled, the culture of ownership he's created, and the capital allocation discipline embedded in the organization. He's built something that transcends himself. So what are the takeaways from Warren Buffett's journey from an 11-year-old buying Citi's service stock to running a company worth close to $1 trillion? First, start early. Not because you need to be young, but because compound interest needs time. The earlier you start, the more time works in your favor. Second, think long-term. The market will fluctuate wildly in the short run, but over decades, value reveals itself. Patience isn't just a virtue. It's a competitive advantage. Third, understand what you own. Don't buy things because they're popular or because someone gave you a tip. Buy businesses you understand, where you can reasonably predict their future. Fourth, quality over price. It's better to pay a fair price for an excellent business than a cheap price for a mediocre one. Quality compounds. Mediocrity deteriorates. Fifth, learn from mistakes. You will be wrong. Everyone is wrong regularly. The difference between good investors and great ones is that great investors extract lessons from failure and don't repeat the same mistakes. Sixth, stay within your circle of competence. You don't need to understand everything. You need to understand a few things deeply and have the discipline to pass on everything else. Warren Buffett's story isn't about getting rich quick. It's about getting rich slowly, which paradoxically is the fastest reliable path to wealth. That 11-year-old boy buying 3 shares of Citi's service learned the most valuable lesson of his life from that mistake. Patience pays. Quality matters. And time is the most powerful force in investing. He's spent the next 83 years proving it. If this deep dive into Warren Buffett's investment philosophy resonated with you, if you're hungry for more stories that reveal the hidden mechanics of how wealth is actually built, then I need you to do something right now. Don't just watch and leave. Subscribe to this channel, because we're not doing surface-level recaps or generic advice you've heard 1,000 times. We're doing the deep research, the real stories, the frameworks that actually work. The stuff that makes you see business and investing differently. Hit that subscribe button. We've got episodes coming on Charlie Munger's transformation from lawyer to investor, the hidden story of Peter Lynch's perfect track record, the psychology of George Soros's market timing,